Whispers of a looming recession are turning into shouts. Many are asking, are we heading for a downturn? Or is this just market noise? The real question isn't if, but what the market is telling us right now. For many, this isn't abstract economic theory. It's about their 401k balances, the value of their tech stock options, or their timeline for early retirement. The find out stage is where market realities hit your personal financial goals. Remember 2022? The S&P 500 plunged nearly 20%, erasing trillions. Many tech workers saw their stock options diminish. This find out stage isn't just a prediction. It's a period of reckoning where market volatility tests your resilience. The core fear isn't just losing money, but losing the future you're building. The FIRE movement, for example, relies heavily on consistent market growth. A prolonged bear market can push back financial independence by years, even decades. So, how do you navigate this uncertainty without panic selling or missing potential recovery? It begins with understanding the difference between market sentiment and fundamental realities. Let's peel back the layers. Historically, recessions are short, sharp shocks. Since WW2, the average US recession lasted just 10 months, but the S&P 500 recovered fully within 11 months post-trough. This data suggests panic selling is often counterproductive. Consider the inverted yield curve, a reliable recession predictor. When short-term Treasury yields exceed long-term, it's a red flag. This has preceded every US recession since 1955, with only one false positive. It's a signal, not a guarantee. Inflation is another key player. When the Fed raises rates to combat inflation, it often cools the economy, sometimes too much. Current CPI data at 3. 1% still indicates sticky prices, putting pressure on household budgets and corporate earnings. Beyond the numbers, behavioral biases play a huge role. Loss aversion makes us feel the pain of a 10% loss more intensely than the joy of a 10% gain. This often leads to irrational selling precisely when the market is cheap. This leads to the herd mentality. When everyone panics, the urge to follow is immense. Yet, legendary investors like Warren Buffett preach, be fearful when others are greedy, and greedy when others are fearful. It's easier said than done, especially now. So, how do the smart money players navigate this? It begins with a disciplined asset allocation. Instead of reacting to headlines, they stick to a predefined strategy, rebalancing periodically to maintain their risk profile. Diversification is your best defense. Don't put all your eggs in one basket, especially in volatile sectors like speculative tech. A well-diversified portfolio across asset classes and geographies can cushion the blow of a downturn. Building a robust emergency fund is non-negotiable. Aim for 6-12 months of living expenses in a high-yield savings account. This liquidity prevents you from being forced to sell investments at a loss during tough times. Dollar cost averaging DCA is another powerful tool. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when high. This smooths out your average purchase price and reduces market timing risk. Ultimately, the find-out stage is not just about survival, it's about opportunity. Recessions often present generational buying opportunities for disciplined investors. The question is, are you prepared to seize them? Seizing these generational opportunities isn't about gut feelings. It's about a predefined strategy. True wealth is built when others are fearful. Are you ready to deploy capital into high-conviction assets, perhaps like S&P 500 ETFs or undervalued tech giants, when the market screams panic? This means having dry powder liquid cash reserves ready to deploy. Top investors like Warren Buffett often hold significant cash during bull markets, waiting for downturns to invest. This isn't about hoarding, it's about strategic positioning for asymmetric returns. Remember Benjamin Graham's wisdom: price is what you pay. Value is what you get. During recessions, the market often misprices assets, offering you the chance to acquire quality businesses at a significant discount to their intrinsic value. Focus on the value, not just the fleeting price. It's easy to succumb to panic selling when headlines scream doom. Behavioral biases like loss aversion make us fear losses more than we value gains. But resisting the urge to sell low and buy high is crucial. This discipline separates successful investors from the rest. One powerful tactic is dollar cost averaging. By investing a fixed amount regularly, regardless of market fluctuations, you automatically buy more shares when prices are low and fewer when high. This simple strategy reduces risk and leverages volatility over the long term. Diversification isn't just about owning different stocks, it's about spreading across asset classes, equities, bonds, real estate, and even alternatives. Ray Dalio's all-weather portfolio exemplifies this, aiming for resilience across various economic cycles. Don't put all your eggs in one basket. Crucially, understand your personal risk tolerance. A young tech worker with 30 years to retirement can stomach more volatility than someone approaching their 401k withdrawals. Align your investment horizon with your financial goals, ensuring your strategy suits your life stage. Regularly rebalancing your portfolio is like steering a ship back on course. If equities outperform, you trim them and reallocate to underperforming assets, like bonds. This ensures you maintain your desired risk profile and don't become overexposed to any single market segment. Don't overlook the tax implications of your investments. Utilizing tax-advantaged accounts like 401ks and Roth IRAs can significantly boost your long-term returns. Understanding capital gains taxes, especially the difference between short-term and long-term, is crucial for optimizing your net profit. The greatest advantage in investing isn't timing the market, it's time in the market. The S&P 500 has historically recovered from every downturn, rewarding patient investors with compound returns. Over decades, this consistent growth can turn modest investments into substantial wealth. The market is a dynamic entity, constantly evolving. Stay updated on economic trends, new technologies, and global shifts. Your financial knowledge should adapt and grow, just like successful businesses in Silicon Valley do. Mainstream financial media often thrives on sensationalism, driving clicks with fear or hype. Learn to filter out the noise. Your investment decisions should be based on diligent research and sound principles, not on the latest dramatic headline from Wall Street pundits. Modern investing is increasingly data-driven. Leverage technology and analytics tools to gain deeper insights into market trends and company fundamentals. While human judgment remains paramount, smart data can augment your decision-making, helping you spot opportunities others miss. Just like a strong business has a moat, build one around your personal finances. This means multiple income streams, keeping debt low, and maintaining a robust emergency fund. A strong financial foundation provides the resilience needed to weather any economic storm and seize opportunities. The find-out stage of the economic cycle doesn't have to be a period of fear. It can be a crucible for growth. Equip yourself with knowledge, build a robust plan, and act with discipline. You are the CEO of your own financial future. It's time to lead it wisely.